Gold tends to rise during moments when official data suggests stability, growth, and confidence across global markets. This contradiction has appeared repeatedly throughout modern financial history, and it is happening again now. In periods when stock indexes reach record highs and unemployment appears controlled, gold quietly moves higher in the background. This behavior suggests that gold responds not to headlines, but to structural pressure building beneath the surface. In 2007, before the global financial crisis became visible, gold prices began rising, even as housing markets and credit expansion were celebrated as economic strength. By late 2008, when confidence finally collapsed, gold had already reflected the stress embedded in the system. This pattern is not unique to the 21st century, nor is it driven by speculation or emotion. Gold has historically acted as a measure of trust in money itself, not trust in markets or governments. When paper currencies function smoothly, gold tends to stagnate or decline in relative importance. When debt expands faster than income and monetary systems stretch credibility, gold begins to move. During the late 1960s, while the United States publicly defended the strength of the dollar, foreign governments quietly exchanged dollars for gold. This silent vote of no confidence preceded the collapse of the Bretton Woods system in 1971. Gold does not speak through press conferences, forecasts, or political language. Its message appears only through price, and historically, that prices move long before official acknowledgement of economic stress. Financial systems rarely fail in moments of panic. They fail after long periods of stability, where risks accumulate unnoticed and confidence replaces discipline. Gold's rise during these periods is often dismissed as irrational or outdated. History shows instead that gold has consistently responded to excessive borrowing, monetary expansion, and weakening currency credibility. This documentary examines gold not as an investment thesis, but as historical evidence. What it reveals is not fear of collapse, but a record of monetary strain already written into the system. Modern financial systems are built on confidence that governments can repay debt and protect the value of their currencies. When that confidence weakens, stress appears first in monetary signals rather than economic headlines. Throughout history, states have relied on borrowing when tax revenue failed to cover expanding obligations. This borrowing often escalated into monetary expansion when debt became politically or economically unpayable. Money originally represented a claim on something scarce, durable, and trusted. Over time, that anchor was removed, leaving confidence as the primary backing of modern currencies. Gold differs from paper money because it is not issued by a government or central bank. Its value does not depend on policy promises, fiscal discipline, or political stability. When governments issue debt faster than economic output grows, repayment becomes mathematically dependent on currency dilution. Inflation then becomes a silent mechanism for reducing real debt burdens. This process rarely appears dramatic at first. Purchasing power erodes slowly while asset prices rise, masking the weakening foundation of the monetary system. Credit expansion plays a central role in this illusion of stability. Easy money encourages borrowing, speculation, and leverage, creating growth that depends on continued monetary support. As debt levels rise, central banks face pressure to keep interest rates artificially low. Higher rates would expose insolvency risks across governments, banks, and pension systems. Low interest rates reduce the opportunity cost of holding gold. When real yields fall below inflation, gold becomes comparatively attractive despite producing no income. This relationship has repeated across decades and continents. Gold responds not to growth itself, but to the method used to finance that growth. Currency systems fail not because people stop using money, but because they stop trusting its future value. That loss of trust is gradual, uneven, and often denied by authorities. Historically, governments have resisted monetary discipline once debt reached critical mass. Political survival favored monetary flexibility over long-term stability. The abandonment of gold-backed systems consistently followed periods of excessive borrowing. Once convertibility constrained spending, it was eventually removed. After the gold standard ended, currency creation accelerated. Debt growth detached from physical limits, allowing obligations to expand faster than real economic capacity. Gold's role shifted from money to measurement. It became a reference point, showing how much currency value had changed over time. When currencies weaken, gold prices rise not because gold improves, but because money deteriorates. This distinction is often misunderstood in modern financial commentary. The signal gold sends is cumulative rather than immediate. It reflects years of policy decisions compressed into price movement. Every major debt crisis followed the same structural sequence. Borrowing increased, monetary discipline weakened, and confidence eroded before collapse became visible. Markets often celebrate stability right before systems break. Gold's divergence during those moments has historically been a warning, not an anomaly. Understanding this pattern is essential before examining historical breakdowns. Without it, gold's behavior appears mysterious rather than methodical. In August 1914, as World War I erupted, Major European powers suspended gold convertibility to finance military spending. Governments chose debt and currency expansion over monetary discipline. Before the war, gold-backed currencies limited how much states could borrow. Once convertibility ended, money supply growth accelerated rapidly, breaking the link between currency and real value. Britain formally abandoned the gold standard in 1931 after losing reserves defending the pound. Gold prices rose as currencies devalued, reflecting declining confidence rather than panic. The United States followed a different path during the Great Depression. In 1933, President Franklin Roosevelt banned private gold ownership to stop capital flight and stabilize banks. In 1934, the U.S. government devalued the dollar by raising gold's price from $20.67 to $35 per ounce. This effectively reduced the real value of government debt by over 40%. The Bretton Woods system was established in 1944 to restore monetary order after global collapse. It pegged currencies to the dollar and the dollar to gold at $35 per ounce. For 2 decades, the system worked because U.S. debt remained manageable. Confidence depended on the assumption that dollars could always be converted into gold. By the 1960s, U.S. spending on the Vietnam War and domestic programs expanded deficits sharply. Foreign governments accumulated more dollars than the U.S. had gold to redeem. France openly demanded gold in exchange for dollars in the late 1960s. This exposed the mathematical impossibility of maintaining convertibility. On August 15, 1971, President Richard Nixon closed the gold window. The dollar became fully fiat, backed only by confidence and policy credibility. Gold was free to trade openly for the first time in decades. Its price rose from $35 in 1971 to over $800 by 1980, amid inflation and currency instability. U.S. inflation reached 13.5% in 1980 as oil shocks and loose monetary policy collided. Gold reflected this loss of purchasing power rather than causing it. Britain faced a parallel crisis during the 1970s. The pound collapsed, inflation exceeded 25% in 1975, and the country required an IMF bailout. Gold ownership surged in Britain as confidence in paper money weakened. This response mirrored earlier episodes across different political systems. Emerging markets repeated the same pattern decades later. Latin American debt crises in the 1980s followed heavy borrowing and currency pegs that collapsed under pressure. Mexico's 1982 default triggered regional instability. Gold rose as local currencies lost credibility and purchasing power. In Asia, the 1997 financial crisis followed rapid credit expansion tied to fixed exchange rates. When capital fled, currencies collapsed and gold preserved value. Russia defaulted on domestic debt in 1998 after years of fiscal imbalance. Gold prices responded as trust and sovereign promises evaporated. Argentina's 2001 collapse followed persistent deficit financing and currency rigidity. Gold ownership protected savings as the peso lost over 70% of its value. Each crisis shared the same architecture. Debt expanded, monetary constraints failed, and confidence disappeared before collapse was acknowledged. Gold did not trigger these breakdowns. It reacted to policy decisions already embedded in the system. Authorities consistently underestimated systemic risk during stable periods. Gold consistently moved earlier than official recognition. These events spanned democracies, dictatorships, and mixed economies. The pattern remained monetary rather than political. History shows that monetary systems break quietly before they break publicly. Gold's movement has repeatedly documented this transition. These case studies are not isolated accidents. They form a continuous record of how debt, money, and trust interact over time. The global financial system entered a new phase after the 2008 crisis. Central banks responded by cutting interest rates to near zero and expanding their balance sheets through quantitative easing. These policies were described as temporary emergency measures. Instead, they became permanent tools, as debt levels made higher rates economically dangerous. By 2020, global sovereign debt had exceeded 100% of world GDP. Governments relied increasingly on borrowing to sustain growth and social stability. The COVID-19 pandemic accelerated this trajectory. Trillions of dollars were created to fund stimulus programs, pushing public debt to historic levels. In the United States, federal debt surpassed $30 trillion by 2022. This level could only be sustained through continued low interest rates and monetary support. Inflation followed monetary expansion with a delay. By 2022, U.S. consumer inflation reached over 9%, the highest level in 4 decades. Central banks responded by raising interest rates rapidly. This exposed the vulnerability of highly leveraged systems built on cheap money. Bond markets reacted with volatility unseen in years. Government borrowing costs rose, increasing pressure on fiscal budgets already stretched by debt. Despite rate hikes, real interest rates remained historically low for extended periods. Inflation continued to erode purchasing power even as nominal policy tightened. Gold prices reflected this imbalance. They rose as real yields declined, signaling monetary stress rather than economic collapse. Central banks themselves began accumulating gold at record levels. In 2022 and 2023, official gold purchases reached their highest levels since the 1960s. Countries like China, Turkey, and Russia increased gold reserves steadily. This reduced reliance on reserve currencies amid geopolitical and financial fragmentation. The dollar remained dominant, but confidence became conditional. Sanctions, asset freezes, and settlement risks altered how states viewed reserve assets. Gold offered neutrality in a divided system. It carried no political alignment, payment obligation, or counterparty risk. Currency swaps and bilateral trade agreements expanded outside traditional reserve structures. These shifts signaled adaptation rather than rebellion against the existing order. Meanwhile, household savings faced quiet erosion. Inflation reduced real income even when wages rose nominally. Asset markets remained elevated despite tightening conditions. This divergence reflected years of accumulated liquidity rather than current productivity. Banking systems adjusted balance sheets under regulatory pressure. Hidden risks persisted as bond portfolios lost value under rising rates. The failures of several regional banks in 2023 exposed duration risk. Deposits moved rapidly in a system dependent on confidence and liquidity. Authorities intervened quickly to prevent contagion. These actions reinforced the expectation of continued monetary backstopping. Gold responded to this reinforcement signal. It reflected not panic, but recognition of structural dependence on policy support. Debt refinancing became a growing concern for governments. Maturing obligations required either higher taxes, spending cuts, or continued monetary accommodation. Political incentives favored delay rather than resolution. Structural reform remained costly while monetary flexibility remained available. This environment mirrored earlier late-stage debt cycles. Stability persisted outwardly, while constraints tightened underneath. Gold's behavior fit the historical pattern precisely. It rose quietly as confidence became increasingly manufactured rather than earned. When debt reaches levels that exceed economic growth, options narrow rather than expand. History shows governments then choose policies that manage appearances rather than resolve underlying imbalance. Inflation becomes the least visible method of adjustment. It reduces real debt burdens while distributing costs unevenly across society. This process does not require hyperinflation to be damaging. Even moderate inflation sustained over time erodes purchasing power and savings significantly. Currencies rarely collapse overnight in advanced economies. They weaken gradually as confidence shifts from permanence to conditional acceptance. Bond markets often detect this shift before consumers do. Rising yields signal increasing compensation demanded for holding sovereign risk. As refinancing costs increase, fiscal pressure intensifies. Governments must allocate more revenue to interest payments rather than productive investment. Historically, this leads to financial repression. Capital controls, regulatory constraints, and negative real yields are used to trap savings within the system. These policies are not framed as emergencies. They are presented as stability measures necessary to protect growth and employment. Banking systems adjust to this environment by holding government debt. This creates interdependence where sovereign weakness transmits directly into financial institutions. Such structures reduce the system's ability to absorb shocks. When confidence wavers, stress spreads quickly across interconnected balance sheets. Gold historically performs during these transitions. It holds value not by resisting policy, but by existing outside policy mechanisms. This does not imply collapse is inevitable. It implies that monetary flexibility replaces fiscal discipline when political constraints dominate economic ones. Previous cycles resolve through reform, restructuring, or reset. The path chosen depended on leadership, timing, and external conditions. Gold's role in these moments was consistent. It preserved purchasing power while systems reorganized around new constraints. The signal gold sends is therefore conditional, not catastrophic. It reflects increasing reliance on confidence rather than structural balance. Gold is often described as a hedge against disaster, but history shows it functions more accurately as a ledger of monetary decisions. It records the long-term consequences of debt, policy, and confidence rather than predicting sudden collapse. Modern economies have not abandoned stability, but they have redefined it. Stability now depends less on balance and more on continuous intervention. This shift explains why gold can rise during periods labeled as strong or resilient. It reflects the cost of maintaining confidence when structural limits have already been reached. Every major monetary reset was preceded by signals that were dismissed as outdated or irrelevant. Gold consistently captured those signals when official narratives could not. The warning gold sends is not about the end of money, but about the condition of trust behind it. When confidence must be managed instead of earned, history shows that systems are already changing.